In problem 10-4A, we are looking at a responsibility report for a profit center. So here we have a company that has a patio furniture division, which is set up as a profit center. Operating data for this division for the year ended December 31st, 2017 is as follows. Budgeted sales was 2.5 million. Cost of goods sold, the variable portion was 1.3. Controllable fixed cost was 200,000. Selling and administrative expenses, variable was 220,000. Controllable fixed is 50. Non-controllable fixed cost is 70,000. And they've told us which of these numbers were favorable or unfavorable. In addition, Clark incurred $180,000 of indirect fixed costs that were budgeted for 175. 20% of these costs were allocated to the patio furniture division. They've asked us to prepare a responsibility report for the patio furniture division for the year. And here they're giving you a little clue. They're telling you the contribution margin is 85,000 favorable, controllable margin is 80,000 favorable. So let's first take a step back and see what we're looking at. Anytime you have a profit center, that division is responsible for their sales and all their controllable expenses. You can't hold them responsible for the expenses that they don't control. The non-controllable expenses, the fixed costs typically, are the ones that get allocated to them. They have no control over that, and you shouldn't ding them for that. So let's see how we're going to set up this information. So I'll start out with sales. The sales, the budgeted number was 2.5 million. The difference from budget is a favorable 50,000. Okay, that means it was more. So the variance was a favorable 50,000. Next, I'm going to list out all the variable costs. Okay, the variable costs that are controllable. So we have cost of goods sold, and we have selling and administrative expenses. The variable ones, they're going to list those over here. So I have 1.3 million and 220,000. These were the budgeted numbers. And each of these, I know what the amount, the variance was, and therefore I can find out what the actuals were. So cost of goods sold variable 41,000 favorable, and selling and administrative 6,000 unfavorable. So if it is favorable, it means I spent less money. If it's unfavorable, I spent more money. And let's look at the totals for the total variable cost. Sales minus variable cost gives me the contribution margin. The contribution margin I have over here, the actual number is better than the budgeted number, so it's a favorable number over here. Now let me go to my fixed costs, the controllable fixed costs. Okay. My controllable fixed costs, again, they're selling and the cost of goods sold, selling and administrative and cost of goods sold, and then I'll go with the totals. Okay, that should be total fixed cost, not variable cost. Okay. So again, I have 200,000 as a controllable fixed cost and 50,000 over here. So I will list those numbers and the totals. Okay. Then I know my variance is 3,000 unfavorable, which means I spent 3,000 more over here, and 2,000 unfavorable. I finally come to my controllable margin. My controllable margin, 730 was the budgeted. My actual was much better at 810, leaving me with a favorable number of 80,000. Okay, so when I'm being evaluated, if this is my division, I should be showing them this. I should tell them, don't hold me accountable for the non-controllable fixed cost and any allocated fixed cost. That's not my problem. Someone else is doing it and dumping it on me. Hold me responsible for this section, and when you see over here, I'm doing pretty good over here. That should be our final defense of our budget over here.